Hey guys, watch this before you apply for like a car loan or a personal loan, especially if you have lower credit scores. I want to share with you a specific loan type that is, I think it's beneficial to be aware of this kind of loan. Now, this is not financial advice. This is just a concept, and I want you to be aware of this because it could save you some money and help you to keep more money in your pocket by being aware of this. There are three general terms that this may fall under. It's going to be a pre-computed interest loan, a rule of 78's loan, or a fixed interest loan. And what this is it's slightly different than a regular personal or car loan, and it's going to be generally offered to somebody who has a lower credit score, limited credit history, or is a higher risk individual. And this is just ensuring that the bank or the lender is going to get their money and their interest back as soon as possible. Okay, so what happens with like a regular loan, if you were to pay your payment off early, let's just say in the first month, like it's generally going to look like this, and interest is in red, principal is in green. So if your payment is, let's just say $1,000, a majority of that first payment is going to be interest. And as you slowly pay that balance off, the interest is going to reduce all the way till the end. So it's more beneficial to pay more payments earlier because they're going towards principal and effectively reducing that interest earlier and earlier to save you guys a lot of money. But what happens with this kind of loan, the pre-computed interest loan, the rule of 78's loan, or fixed interest loan, you're going to want to like specifically look into the details, especially if you have bad credit or something like that. Sometimes like car dealerships, maybe smaller ones that offer their own financing might have this. But what happens here is the interest payment stays the same whether you pay early or not. Okay, so this is just something you should be aware of and really research yourself if you're thinking about getting any kind of car or personal loan, debt consolidation loan. All right, so what happens here is these are not actual numbers. These are just numbers that I made up to give you a mindset and something to think about, okay? So let's just say that first payment is 90% interest and 10% principal. The next payment is 85% interest and 15% principal. The next one is 80% interest and 20% principal. What's happening if you make a payment early? The very last payment is generally going to be mostly principal and not that much interest at that point because of just the way that the loan is going to scale. So a majority of interest is in the front and a very little bit of it is going to be at the end. So what happens when you make an early payment, all you're doing is buying yourself out of the interest on that last payment. So if it's like 10, 5, 3, 1% of that last payment is actually interest, then all you did by paying that early is buy yourself out of that like last bit of interest. Okay, that really tiny 1%. And it would have been more advantageous to invest that money or do something else with it where you could actually make a little bit of capital appreciation, some dividends, things like that. All right, so this is not how most loans work, not how mortgages are going to work, but this is a specific pre-computed interest loan where the interest is kind of already structured throughout the loan, and by paying early, all you're doing is buying yourself one earlier month of freedom. Now, in that case, if that's something that you want to do, you feel good about, you don't really care about the cash flow, then go ahead and do that. But if you're thinking from a cash flow standpoint of maybe my last payment is only 0.25% of interest or however that works, I can't give you exact numbers because every loan is going to be different. If that's all I'm saving on that last payment, maybe I should just not pay that payment early and just invest that money instead if I have it and mathematically I'm going to have more money left over after that. So that's just something I wanted to share with you guys real briefly. Rule of 78's loan, pre-computed interest loan, or maybe a fixed interest loan are just some of the terms, and I would really look into the paperwork. The point that I'm sharing you is I just want you to think outside of the box. I want you to raise your level of awareness. So if you actually need a loan or you have to get a car or something like that, I want you to understand, why am I bringing this up? I want you to understand that there are so many different nuances and types of loans and different factors to think in when I'm getting the loan. Okay, so I want you to just become more aware of how money works and how banks and lenders are going to work so that they can get the most amount of money from you as possible. If you can become aware of this, maybe you decide, you know what, that loan actually doesn't make sense to me. Maybe it's a 10% interest loan and a majority of it's going to be paid right in the beginning. Like there's no way I'm getting out of that. Maybe it may cause you to think differently. But if I could encourage one person to just stop and evaluate the type of loan that they're getting before they actually go and get that loan, that could save you a lot of money over the long term, just by raising your level of awareness and just knowing that, oh, there are different kinds of loans that sound very similar, and just even thinking about how loans work. Before you get any type of loan, I think that you should just understand how interest is calculated and things like that. So I just wanted to share this with you guys real quick, because maybe one person is about to buy one of these, or not buy, but apply for one of these loans on a car and not realize exactly how it works. So all I want you to do at Money Moves with Nick, all I want you to do is think outside of the box. Think about money differently. Have a higher understanding of how life works. If you have that level of understanding of how life works, you can make better decisions, okay? The best way I could describe this is money is made in the mind. Money is made through ideas and knowledge and being aware. People lose money because they're not aware. People who know the rules, people who know the laws, people who know how interest is calculated, those people who have that deep understanding of how things financially work in society are more prepared to be successful than those who are not. They're like, oh, yep, got a loan. I just got to make my payment. Yep. And they just think about it at that surface level. You're losing out on tons of money that you're spending in interest. And how do I know about this? Because although my loan, I had to get a car loan at one point. So just understanding, like, holy crap, like I didn't know that interest worked this way. I didn't realize that, even something as simple of it's 12% on the total loan balance, or 10% or 5% on the total loan balance the whole time. It's not like, let's just say you have a 10% loan interest and you have a $10,000 loan, okay? It's not like, oh, 10,000 and it's 10%. Oh, it's only an extra $1,000 to put this on a loan. That's no big deal. It doesn't work like that. It's not like 10% of 10,000. It's 10% of the balance compounding. So 10% over, it's 10% per year. So if it's like a 5 or 6 year loan, I mean, we're talking like you may mathematically, and I'm butchering this because I didn't think about it beforehand. If it's a 6-year loan and it's 10% per year on the balance, then I mean, I may be paying 30 or 40% in interest by the end of the 6 years total, instead of what I maybe thought was that first 10%, because 10%, that's not a big deal, or 5%, that's not a big deal. It's 5% compounded year by year by year by year. So it's 5% the first year, 5% the second year, 5% the third year, 5% the fourth year, 5% the fifth year, and 5% the sixth year, in relation to that total balance. So if my total balance ends up being like, 9,000 by the end of the first year, it's 5% of 9,000. Then if it's 7,500 the next year, it's 5% of 7,500. And I need to add all that up to get the total amount. So that's why I think you should look at the total interest amount that you're paying. Because especially with like a house or a mortgage, I don't think you understand, like if you get a house at like 6%, let's just say it's like $300,000, you're probably paying $150,000 in interest by the end of that 30 years. And I'm confident that there's people out there that have no clue how this works and how compounding works. And if you just understand how the compound effect works on interest, you can realize that that same compound effect works if I'm getting interest on my money. So think of all the extra money that I paid on interest versus if I invested that money instead, and all the compounding interest that I made over the period of time. So think about this. Let's just think about a mortgage. Let's say 6% for 30 years. What if I could get 6% for 30 years in interest on my money instead of paying that in interest? Think about how much money that would be over those 30 years that I would have. Just now we talk about the amount of money that I have versus the amount of money that I would have lost, and now the gap is just that much wider if I were to invest that money instead. So think about opportunity costs. Think outside of the box. Just look at how loan works. If you are about to buy a car loan, why I keep saying buy. If you are about to apply for a car loan, if you're about to buy a car and get a car loan or a personal loan or a debt consolidation loan, I just want to encourage you to think about how loans work and how cash flow works, how opportunity cost works before you actually do something. That's all I'm encouraging, not financial advice. I want you to just take a moment and learn about what you're doing before you make a decision. Have a wonderful day, guys. You're watching Money Moves with Nick.